In this video, we are going to start with the topic of revenue recognition that is covered by IFRS 15, revenue from contracts with customers. So first of all, we have to know what is the meaning of revenue as per IFRS 15. So I'll just briefly take you through the entire concept of revenue. IFRS 15 has defined revenue as income arising in the course of an entity's normal trading operating activities, meaning that for a particular business, any revenue that is generated from trading activities or from manufacturing activities, if you are manufacturing and selling goods, then on the sale of goods, the revenue that is generated, which is a part and parcel of your operating activities, that is going to be called as revenue as per IFRS 15. Revenue presented in the statement of profit or loss should not include proceeds from the sale of non-current assets or sales tax. So that means sometimes what happens is, along with the selling price, along with the sales invoice, we add the sales tax and we send it. Now, why the sales tax is not to be included? The sales tax is not to be included because of a simple reason, that the sales tax will be reimbursed. So when you are charging the customers, actually you are charging the customers with the amount of sales tax which is payable to the government, and at the time of purchase of the raw materials which you have done for the purpose of manufacturing those goods, you must have paid the sales tax. So now you are recovering the sales tax. So it is just a recovery of the amount. So it is not an expenditure for you. The sales tax is not to be included. Second, they are saying that it is not going to include the sale of non-current assets, because if you remember, I told you that it is from normal trading activities. And normal trading activities do not include the sale of non-current assets. So if you are selling plant and machinery, that is not a part of your business activity. So that income or that revenue that is generated from the sale of non-current assets should not be included as a part under IFRS 15, right? Now, what does IFRS 15 say? To recognize revenue in the financial statements. Now we have studied what is the meaning of recognition. Recognition means including the item in the financial statement. So whether that revenue should be included in the financial statement depends upon several factors. So first of all, whether it is a contract or not. There is a contract between you and the customer or not. So IFRS 15, which deals with the revenue from contracts with customers, says that there is a 5-step process which we have to undertake to determine whether revenue will actually be included in the financial statements, meaning revenue will actually be recognized in the financial statements or not. Correct? So let us see what are those 5 steps which are involved in the recognition of revenue. So the first one is identifying the contract. Identifying the contract. That means first, when you are going for finding out whether revenue is going to be recognized in the financial statements or not, the most important thing is that the origin. Is there a contract between the entity and the customer? What is a contract? As per law, we have all studied that as per law, any agreement which is enforceable by law is a contract, right? So we have to see whether there is an agreement, whether it is enforceable by law, whether it can be called as a contract, right? Whether there are legal enforcement obligations. Then only we can say that yes, there is a contract existing between the entity and the customer, and whatever we earn as inflows of cash from that particular contract can be recognized as revenue. Again, revenue, we have to satisfy the definition as given in the conceptual framework. So what is revenue as per the conceptual framework? Revenue as per the conceptual framework is anything that increases the assets or decreases the liability. So if it increases the assets, yes, it will give rise to cash inflows. It will give rise to accounts receivable. So it increases the asset. So then it is to be included in the financial statements. Like that, the second step is identifying the separate performance obligations within a contract. What is a performance obligation? See, every contract may be based on buying and selling of goods. So there is an obligation on one party to sell the goods, and there is an obligation on the other party to buy the goods and in return pay a consideration on the performance, on the satisfaction of a performance obligation. So what is a performance obligation? Is there one single performance obligation or are there multiple performance obligations? So that has to be identified. Okay, we'll see that because we have to see each of these 5 steps in detail. So whether there is a performance obligation, whether that performance obligation is to be satisfied individually or collectively, whether it is satisfied at a point in time or over a period of time. Third is determining the transaction price. That means we have to find out whether the transaction price is comprising of any variable component or it is a fixed component, right? So we will have to see what is that variable component and how to calculate the transaction price. Sometimes the transaction price is having inbuilt interest factor, which we say that it is a finance cost, an inbuilt finance cost, a hidden finance cost. So we have to find out what is the actual transaction price. Then allocating the transaction price to the performance obligations in the contract, in the sense that once we know what is the contract price and we know that each particular performance obligation can be done individually and they have a standalone price, then apportionment or allocation of that particular contract price to the various performance obligations. Again, this is something which will require detailed working and explanation. And lastly, recognize the revenue as and when a performance obligation is satisfied, meaning that as the seller satisfies his part of the obligation, payment of that particular consideration and the seller recognizing that particular revenue in the financial statements. So it is a 5-step process, right? So let us see each one of them in detail as is given. Step number 1 talks about identifying the contract, whether there is a contract or not. As I told you, for there to be a contract present, we should have an agreement between two parties where both the parties understand and recognize their part of the obligation, what they have to do, what are the payment terms, how the payments will be made, and so on. So you can see here that there are 4 points listed here. What are the 4 points for there to be a contract? The first one is that the parties have approved the contract and each party has understood and identified their rights. A seller has understood his right that he has to sell the goods on receiving the consideration. A buyer has understood his rights that on delivery of the goods he has to make the payment of the consideration. So there will be 2 parties, as I said, an agreement between 2 parties that creates rights and obligations on the part of both the entities, right? Second is payment terms can be identified. How the payment will be made? The payment can be made upfront at the beginning of the contract, or the payment can be made at the end of the contract, or the payment can be made on a progressive basis as and how the performance obligations are performed, right? Then contract has some commercial substance. The risk is transferred, the ownership is transferred. So it is not just a mere agreement which is not enforceable by law. So there must be some commercial substance. And lastly, it is probable that the entity will be paid. Nobody sells with the objective that I will not be receiving the amount and I will not be showing the revenue and I will suffer a loss, right? So whenever there is a contract to sell goods, there is always the possibility I sell goods because I have this possible idea, the positive idea that I will be receiving the revenue from the sale of the goods. So probability of receiving the consideration is always there. If there is no probability of receiving the consideration on account of some factors, then you cannot recognize the revenue as per IFRS 15. So at the time of sale of goods, the customer, you checked on him and you found that yes, the customer has got the capacity to pay, he will pay. His past track record shows that he has been making payments in the past to all his suppliers. Fine. So there is probability that the entity that I will be receiving the income. But after, let us say I have given the customer 4 months credit period. After 2.5 months, I find that the financial situation of the customer has weakened and he is not in a position to make payment. And the likelihood of me receiving the payment is not there. Then I cannot recognize that revenue because that is irrecoverable debts for me, what we call as bad debts. So if the amount is irrecoverable and I know that I am not going to receive that amount, I cannot recognize that revenue in my financial statements as per IFRS 15. Right? So that is the first step, identifying the contract. Second step is identifying the separate performance obligations within a contract. What is a performance obligation? And how many performance obligations can be there? We can have one single performance obligation. Like for example, you come to my shop, you purchase a television set, I sell the television set to you, you pay the price. There is only one single performance obligation that has been satisfied and consideration has been paid, right? So that settles the transaction. So in my example now, I have said that you have come to my shop, purchased a television set, and I have sold the television set, you have made the payment of the consideration. But there is a possibility that there are multiple performance obligations. For example, when you come to my shop to purchase a television set, I say fine, this is the television set, this is the cost of it. I tell you the cost is around 80,000. You say, okay, I'm interested in buying, I want to purchase. So the deal is made. Then I ask you, do you have a dish antenna? You say no. I say we sell dish antennas also. So you are interested, you have a look at it, and you like that dish antenna that I have provided to you, and you say I want to buy this dish antenna also. So that means I will charge you another 10,000 for that. So let us say I have charged you about 80,000 for the television set. I have charged you another 10,000 for the dish antenna, and then I say, do you have any person to install this? You say no. I say we will send our person. We are doing the installation also. So 80,000 plus 10,000 plus I will say installation charges, another 2,000 rupees you have to pay. So 92,000 you have to pay for the total contract. I say 92,000 is a little bit odd figure. Can you reduce it to 90,000 and make it a round figure? I say okay, fine, since you are taking all the three from me, I will reduce it to 90,000. So 90,000 becomes the transaction price. But there are how many obligations? 3 obligations. Selling a TV set, selling a dish antenna, and providing you with the installation service. So there are 3 performance obligations. Right? I can sell each one of them individually also. So suppose a person comes to my shop and says that, I have purchased a dish antenna, I want somebody to install it. Do you have anybody? I say yes, my mechanic will come and install the dish antenna for you. So I provide only installation services also. A person may come to my shop and say that I have got a television set, I want to purchase a dish antenna. He comes along with his own mechanic. He says that dish antenna I want to purchase, so I will sell only the dish antenna to him. I will not sell the TV set, I will not provide any installation service. So I can sell each of these performance obligations individually and each one has got a price. Individual price of each performance obligation is called as standalone price of that performance obligation, right? So performance obligations are promises to transfer distinct goods or services to a customer. Distinct performance obligations within a contract must be identified. A promised good or service is distinct if, what are the 2 conditions? The first condition, customer can benefit from the goods or services on its own or by using resources that are readily available. So when I provide a television set for you, can you enjoy the benefit of that television set? Yes. You may be having your own dish antenna, right? You just have to connect it and play. Second, the promise to provide the goods or services separately identifiable from the other contractual promises. I told you, yes, I've got 3 performance obligations and 3 of them can be separately identified. 3 of them are separately sold. Individually, they have a price. So that is the meaning of having a performance obligation, right? Now, an entity must decide the nature of each performance obligation. IFRS 15 says that this might be to provide the specified goods or service itself, or to arrange for another party to provide the goods or service. That means when we have principal and agents, where I am having an agent in different parts of the country to sell goods on my behalf. So I am called as a principal. Now those agents to whom I am appointing to be in different parts of the country to sell goods on my behalf, I may be sending goods to them, not selling. I am sending the goods to them, and I am telling them that if the customers approach you, tell them the price. If they are asking for discount, this is the discount that you can give them. On the sale, please inform me. So the agent will try to get customers for my goods, and he will be selling the goods on my behalf. So to provide the specified goods or service itself, who's providing the goods? I am providing the goods. I am providing the service. So I am the principal. Who's selling the goods on my behalf? The agent. The agent is not selling the goods on his behalf. He is selling the goods on my behalf. He is representing me. So when goods are sold by the agent, who will record the revenue on the sale of goods? I will record. The principal will record, not the agent. Agent has not sold the goods. It is not his revenue. Agent has sold the goods on my behalf, on behalf of the principal. So it is a principal's revenue. So in the books of principal, the revenue on the sale of goods will be recorded. So what will the agent record then? The agent will also record some revenue, but that revenue is the commission that he is charging on the sale of goods. The commission that he is charging on the sale of goods. The sale of goods is not his revenue. The sale of goods revenue is the principal's revenue. The commission on the sale of goods is the agent's revenue. Correct? So, an entity is the principal if it controls the goods or service before it is transferred to the buyer. If an entity is an agent, revenue is recognized based on the fee that it is entitled to, the commission or the fee that the agent is entitled to. Clear? We'll be solving problems on this. Nothing to worry. Coming to step number 3, determining the transaction price. Now this step is very important because there are different types of transactions involved over here. So let us go through this. Determining the transaction price. IFRS 15 defines the transaction price as the amount of consideration that the entity expects in exchange for satisfying a performance obligation. That means on the sale of goods, how much am I expecting? That particular amount is the consideration on the sale of goods. Right? On providing a service, installation service, what is the amount that I am charging you? That is the transaction price. Sales tax is excluded. Again, they are saying the same thing. Sales tax is excluded. Why it is excluded? Because it is a reimbursement of the payment that you have made earlier. On the purchase of the goods, you have paid the sales tax. The supplier has charged you on purchase of raw material. Now, on the sale of the finished goods which you have manufactured with the help of that raw material, you are charging your customer the sales tax. So it is like a reimbursement of the payment that you have already made. Fine. So it is not an expenditure for you. Therefore, it is not going to be taken as a part of revenue. When determining the transaction price, the following must be considered. 4 things. Variable consideration, significant financing components, non-cash consideration, and consideration payable to a customer. Let us look at this, each one. Variable consideration. If a contract includes variable consideration, then an entity must estimate the amount it will be entitled to. Now, what is the meaning of this? The meaning of this is how we talk about variable component. What is the variable component? How does it come into existence? And how to look at it like. Let us say I want to construct a building for myself. I've got a plot of land, and on that plot of land I want to construct a building. So I contact a builder, a developer, and he says that, sir, it will take minimum 4 months to complete the building. I say, fine, but I am in urgency. Can you speed up your process, employ more workers? He says, it will be difficult, but I will try. So I say, fine. He charges me 90 lakhs for the construction of the building. So I tell him that 90 lakhs you are charging for the construction of the building, and you are saying that it will be completed in 4 months. Now, if you complete the building in 2.5 months, I will pay you 10% bonus. Over and above 90 lakhs, I will pay you 10% bonus. If you complete the building within 3 months, I will pay you 7% bonus. If you complete the building within 3.5 months, I will pay you 5% bonus. And if you complete after 4 months, there is no bonus. So there is a variable component, 10%, 7%, 5%. So what is the transaction price? I cannot say transaction price is 90 lakhs, because if the contractor completes the building in 2.5 months, I will have to pay him 90 lakhs plus 10% of 90 lakhs, that is 99 lakhs. So like that, the consideration becomes variable. Now, how to calculate over there? You have to see what is the probability. What is the probability that building will be completed within 2.5 months? Multiply that probability with 90 lakhs plus 10%. What is the probability that building will be completed in 3 months? Take that probability into 90 lakhs plus 7%. What is the probability that building will be completed in 3.5 months? Take that probability multiplied by 90 lakhs plus 5%. Okay, what is the probability that building will take 4 months exactly to complete? Probability into 90 lakhs, because there is no bonus. You get all those values, take the total of that is your transaction price. Correct? So that is your variable consideration, right? Let us come to the significant financing component. Okay, guys, I just want to tell you, something that we always feel. Many of you must have gone on Amazon, purchased a lot of items from Amazon, and when you are purchasing the items, you always find at the end, below the transaction that you are having, that there is a 0% EMI also available, EMI options available, 0 interest EMI. Okay. Now, sometimes most of the times people are induced to say that, hey, Amazon is great here. It is providing us EMI and it's not charging a single paise as interest. Tell me one particular business, students, tell me one particular business where the business is not requiring profits, except a charitable institution, a charitable trust. No business is formed with the objective of doing charity. No business is formed with the objective that I don't want a profit, I will sell cost to cost. Every business wants profit. So when I tell you that it is the price you can pay today also, or after 6 months also, or after 2 months also, or after 1 year also, and we will show you the EMI calculations, there is no interest involved. It is total amount divided by number of months. It is all crap. Nobody does business without the motivation of profit, without the intention of profit. So even in the case of Amazon, they are having the price which is inbuilt of interest. That is the hidden cost. That is the hidden cost. So financing a transaction where you are told that, either you pay today or after 2 years, EMI, no interest EMI, 0% EMI, it is all nonsense, because that interest is already inbuilt into that price and you do not know, but the person who is selling it has already done his calculations. So the financing component is already there in that transaction price. So if you are a commerce student, you will take advantage, because anyway you are paying interest. So why pay interest now? I will pay interest by delaying the transaction payment. So take advantage of the 0% EMI, because either way you are going to pay interest, you are not going to have a discount. So if the transaction price is 4,000, either you pay 4,000 now or you pay 4,000 after 1 year. As a commerce person, I will say, okay, fine, I'll pay 4,000 after 1 year. Because you are charging me interest on that, it is included in that 4,000, I know it. So why should I pay the interest now if I'm getting the benefit of paying that same amount? You are going to charge me that interest whether I'm paying now or I'm going to pay later. So I'll say I will pay after 1 year or over a period of 1 year. So whatever interest I'm paying to you, I will get by keeping that amount in my bank account. Right? So financing, that financing component is already included, and we have to find out by discounting with the rate of interest that is applicable in the market as of today. We have to discount and calculate what is the present value of that 5,000. The present value of that 5,000 or that 4,000 will be the actual transaction price. So suppose you discount 4,000 at X% interest and you get the amount as 2,890. The 2,890 is the actual price. The difference between 4,000 and 2,890 is actually the interest component. Correct? So that is the financing part of it. We'll come all to all this. We'll solve all this in the form of examples, problems. Non-cash consideration. Any non-cash consideration is measured at fair value, market value. If the fair value of the non-cash consideration cannot be estimated reliably, then the transaction is measured using the standalone selling price of the goods or services promised to the customer. So if there is something that you are giving which is not in the form of cash, then that non-cash consideration comes into play. Let us say that you are issuing shares to the customer, or for example, a contractor has constructed a building for you. We are a company form of organization. Contractor has constructed a building for you. Instead of paying him in cash, you are paying him in the form of shares. Then consideration payable to a customer. If consideration is paid to a customer in exchange for a distinct good or service, then it should be accounted for as a purchase transaction, assuming that the consideration paid to a customer is not in exchange for a distinct good or service. An entity should account for it as a reduction of the transaction price. Now, for example, let us say I want to sell my goods, but my goods require storage facilities, cold storage facilities. Okay, so I tell the customer, I ask the customer who's buying the goods from me, are you having adequate storage facilities? Let us say a retailer is buying the goods from me. I am the company, and the retailer is buying directly from me. So I ask the retailer, have you got adequate cold storage facilities to store my goods? He says, no, sir. But then I will be at a loss, because if I will sell the goods to him and he is not able to sell the goods forward to the customer, and those goods are perishable goods, they require cold storage facilities, and they are not sold in time, then I will suffer loss. So I tell, okay, fine, I will ensure that there is a cold storage facility at your retail shop, and I construct, and for him I pay him additional amount. I say, okay, take this amount, construct the storage facility, and then I will sell the goods. So consideration is paid to a customer. Consideration is paid to a customer to build the storage facility. That is consideration payable to a customer, which has to be deducted from the transaction price. So what they are saying, it should be accounted for as a purchase transaction, and it should account for it as a reduction of the transaction price. So whatever I am paying the customer or the retailer will be deducted from the transaction price to arrive at the correct transaction price. Okay, so these types of things are not normally seen in a sale transaction. You must have not come across these type of adjustments in the sale transaction. So that is why we have to do each one of them in detail. We have to take up examples based on this, and we have to solve the problems. Right? So this is what we are planning to do in the revenue recognition. Fine. I'll be back again with the formulas, with the calculations, with the problems, with the questions and the solutions to be done. Fine. So see me back in lecture 2.